Welcome to the Real Estate Raw Show, hosted by Joe Mendoza.
Hi guys, Joe Mendoza here in sunny San Diego. Welcome to my show. Thanks so much for watching, subscribing, and sharing the great words of wisdom on our show. If you like what you're hearing, smash that subscribe button, share with a friend. Guys, as I always say, take a lot of notes, a lot of notes. Learn before you earn. Today's special guest, guys, I've had a lot of great guests on this show. And whenever you talk about self-storage, his name pops up a lot. That has something to be said about this man you're about to meet. Mr. Scott Meyers has been investing in the self-storage business for a long time. He's also an instructor. He runs his own trainings and camps, etc. But you be the judge for yourself. Do your due diligence. Check him out. Ladies and gentlemen, get ready. Super excited to have Mr. Scott Meyers on our show today. Let's watch. Ladies and gentlemen, I have the man, the myth, the legend himself on our show today, Mr. Scott Meyers himself. Scott, how are you doing today?
Joe, I am doing fantastic. Good to be together with you again.
Yeah, absolutely. So I've heard a ton of great things about you. I've met you before. A lot of people, whenever they talk about self-storage, your name keeps popping up. All right. So for my audience who doesn't really know Scott, share some backstory. You got into the business. How long ago? What were you doing before that? Pre-self-storage.
Sure. Well, got into real estate back in 1993, and it all started with the home study system by Mr. Carlton Sheets, believe it or not. And, many folks have heard that name. Some folks out there haven't. But the whole process of getting into real estate was born out of this idea that Carlton had of owning 15 houses free and clear at some point. You buy 15 houses, you put 15-year mortgages on them, and they're paid off in 15 years, and you sail off into the sunset with the cash flow. Well, we started doing that process, buying VA, assumable mortgage rental houses in working class neighborhoods, 3-bedroom, 1-bath ranches in the bread and butter parts of the neighborhoods here in Indianapolis, and continue to do this as kind of a hedge to my retirement funds that were on Wall Street. Read Rich Dad Poor Dad, like most folks out there, and realized that I didn't want to rely on my retirement in the big casino on Wall Street. So that's when we started buying single family rental houses to kind of supplement retirement. Well, it got kind of fun, kind of addictive. I'm a junker at heart. I used to fix bikes and sell them to kids in the neighborhood, and I did it with cars, and now I was starting to do it with houses, and the commas and dollars, commas and zeros were a little bit greater, and so we were having kind of fun. And then along the way, the dot-com crash of 1999 occurred, and the company that I was working for was a tech company, and I watched $350,000 of my retirement go down the tubes. In the big casino on Wall Street, because all my retirement was held in stock in this company in the tech sector, which tanked. So I began to put pencil to paper, and my wife and I took a look at, where do we go from here? And, when you lose 350 grand, that's kind of a pivot point. And so, the real estate was doing well. I was getting an income stream from it, and it was building up retirement just as I had designed for it to do. So I thought, well, gosh, why do I want to continue to work for a company who's cooking the books and get caught and, ruin my retirement? Why don't I just go full time into real estate where I know who the managers are and the boss is, because it's me, and we don't have to worry about somebody cooking the books, because then I'd just be screwing myself over. So we made the decision to go full bore into real estate. And, we struggled in the beginning. I think we probably exited a little too soon. We only had about 20 houses that weren't throwing off enough income that we wanted to, cover all those costs of owning real estate and then having, the lifestyle that we wanted. So we thought we need to ramp it up, started buying apartment complexes. And then, we got to a place where we had, the cash flow was coming in. We had 75 houses and 400 apartments, but the free time to be able to do anything else was not there. And we were in the landlording business. However, we did have property management companies, but as everybody knows, there's still decisions that need to be made, checks that need to be written for whatever problem is occurring. And we really just kind of grew tired of the tenant and toilet business. And so we began looking around the real estate landscape. And if you don't like, tenants and toilets, there's not much left. It's self-storage or parking lots, and you can't build a lot of value in parking lots. And so we began looking into self-storage. There wasn't anybody out teaching really about how to invest in it. There wasn't a guru to go to. There wasn't a Carlton Sheets of self-storage. And so we learned on our own, hired a lot of consultants, went to the trade shows, talked to a lot of folks, and launched and got into our first self-storage facility, and then, really never looked back ever since then. Just started buying value-add self-storage facilities like we're doing with houses and apartments. And then along the way, I was the president of the Central Indiana Real Estate Investors Association here in Indianapolis, and started holding workshops. People began then asking about what we were doing in self-storage. And really our second business was born out of that. We had one of the nation's the agents for the RIAs across the country who books the speaking engagements for the national speakers came to me and said, "Hey, we need somebody to speak on self-storage. I understand you're the guy. I'll help you write a course and a presentation, and you can go out there and talk to these other RIA groups and to buy your stuff." And I said, "Well, that sounds good, because I see the checks that I write for the folks that come through our group." And before long, I found that I had really now 2 60-hour-a-week businesses on the investing side and the education side. And so, I'll land the plane here. The long story short is we've really refined who we work with and what our education company looks like, and really integrated that with our investment company. And we think we got the right mix right now. And we've been out, doing this for 15 years, got into storage in 2005. And since then, we've grown both platforms, the investing platform, which includes our syndications and our private equity folks that come into our business, and our students. We've taught a lot of folks that are in the industry now, came through our doors of our education company. We're the nation's largest self-storage education company that teaches people how to find, buy, manage, acquire self-storage facilities, and then how to grow and scale them as well. And I'm really proud of my team and what we've built over the years. And we're just doing it. Right now, the industry is just going gangbusters. So there's a whole lot of folks looking to invest with us, and a whole lot of folks looking to learn about it. And so we've got a tiger by the tail, and just loving every minute of being in the storage business right now.
That's awesome, Scott. What a story. Now, I'm going to dig deep on some of those things in between there. Now, you've been through several different cycles at this point.
Yeah.
And we're in or going into another cycle. One of my clients, one of my friends, they're cashing out. They were kind of like you. They had the single family, and they're like, you know what? I'm just going to cash out all these properties. I'm tired of tenants. I'm tired of toilets. I'm going to park all my money in this Vanguard mutual fund or index fund. What are your thoughts when somebody says like that?
I haven't looked at the Vanguard mutual funds, so let me first place a disclaimer on that I don't know what it's returning. And then also, I don't know what kind of returns your friend had when he was in real estate. If he was running it well, probably doing a little bit better than the Vanguard fund, and then also being able to write off the interest and depreciation. There's tax benefits of owning real estate, plus the fact that you can see it, touch it, feel it. Again, you put me on the spot here, Joe. I can't talk badly about a mutual fund, but I'll just talk in general that I really don't want to rely on what those folks are doing, to be honest with you, because you don't know who they are. And really, I think the greater conversation that we need to have right now, Joe, is that we're looking at inflation that the government is stating at about 6.2% right now in our country. But when you peel back the onion and you look at what they've taken out of that, they've taken used cars out. We consume those. The consumer price index. Well, people are buying cars, and we've all seen that used car prices have gone up 40%. Since COVID, because we can't get the semiconductors, and there's a shortage of steel, there's a shortage of supplies. There's many other items that we buy on a regular basis that the government unfortunately has selectively taken out of that index. So, when you look at the economists who really peel back the onion and look into what is the true consumer price index and true inflation rate, most of these folks will put it at peg it closer to 15%, and some as high as 20%. So if our inflation rate right now is at 15%, and we're seeing the government, and this isn't a government bashing session either, Joe, but the government's been printing money, and the value of the dollar has been reduced by 30% per year because of the money that continues to be printed. Well, at the very least, you need to be making more than 15%. You need to be earning more than 15% on your money that's invested to keep up with the inflation rate. Otherwise, you're going backwards. And that doesn't even take into account the devaluation of the dollar. So I think right now, real estate is one of those games, and it's not a game, but one of the only games in town that you can borrow money to buy it. You can create value, and then you can depreciate it and put somebody in, the facility, the storage facility, or the rental unit or the apartment to pay down your basis. there's still nothing that beats real estate from that standpoint. So I guess that's my long-winded, unprofessional, unpaid advice to your friend.
No, you nailed it. You nailed it. I mean, you hit up a lot of different points about appreciation and cash flow. And kind of what I said to her is like, she said, hey, I'm making about 22% and 23%. And I was a little dumbfounded and I almost hit that speechless point. But I said this, I know that's great, but guess what? You don't have passive income. You don't realize it till you sell it, and so it's like, to my point, I was like, you don't have passive income. I don't care if it's 20%, 50%, 1,000%. This morning I was sharing with one of my clients, hey, I bought Facebook at 30. I bought Facebook at 30. I'm up over 1,000%. But so what? I don't have passive income from Facebook. So it's like, all right.
So realized gain, and it doesn't replace your cash flow. So
exactly. So self-storage, this is an asset class I'm getting super, super excited about because, when you talk about like make readies and all these other things, when you get a regular residential property, you're cash flowing 100, 200, 300 a month. But at the end, now you got to replace carpet, you got to do paint. Then you look at the overall return, it's next to nothing. Self-storage, what are some of the key benefits? I kind of hinted a little bit to self-storage.
Yeah, well, I'll take that hint. And make readies. Let's talk about that first of all. Yeah, no carpet, no drywall. Our make readies when we were in apartments was about $1,300 on average, and that depends on what part of the country you're in. That's either good or bad, depending upon who's listening. But that's our lost rent and advertising and carpet and paint. Average on a turn, and then out 30 days or so. Well, in self storage, when they move out, we take a gas or electric blower and we blow it out, and in 30 seconds and with almost zero cost, we can move in the next person waiting in line. So our make readies are breeze, if you will. If you look at just the averages, also comparing asset classes, and not to beat up on multifamily or apartments, but it's the nature and the difference between them, or the nature of the real estate business is that when you have apartments, and I use apartments because I was in them, and that's the asset class that is most commonly compared with with self-storage. And so when I begin to look at the numbers, the operating ratio for apartments is about 50%, meaning for every dollar you bring in, about 50% or 50 cents is given up in expenses. That's the income to expense ratio. Self-storage, the national average is just above, between 30 to 31%. And so for every dollar you bring in, you're only paying 30 to 31 cents in operating expenses. And a lot of that is because, we don't have a lot of payroll to run it. And some of our facilities are unmanned. We have a kiosk that are running it. You don't want to have maintenance crews because there's nothing to maintain, essentially. I mean, we got door springs that they need to, grease every once in a while or replace it, and, weed control, and that's it. But we don't just have the ongoing maintenance and the ongoing people, that we have to sell or, sit in the office or write letters, to them to tell them to stop parking on the grass and to, keep the dogs from fighting with each other and stop lighting off fireworks and, all that babysitting. So it's a very labor non-intensive type business. And so from that standpoint, we love it. Another is that, in habitational real estate, which is single family and apartments, it's always been difficult to get people to pay if they can't pay. And now combine that with the fact that, once again, I'm not trying to bash our government, but, at all levels, they're saying, well, big bad landlord, you're too rich and you don't need to evict anyone just because we're going through a tough time in our economy. And last time I checked, that's kind of the way capitalism works. So the folks that rent apartments and single family rentals have been left holding the bag. Well, storage, we don't fall under habitational real estate laws. We fall under lien laws, which means if you don't pay, we put a lock on your unit. If you still don't pay, we get to sell your stuff off, and we can legally do that. Storage is an essential business. It has survived and thrived during the pandemic because we don't have to have a person even in the office to run it. We run our facilities with a kiosk, and so huge need during the pandemic and the recession. So it's very pandemic proof and recession resistant. And that we know businesses have gone under, unfortunately, and are downsizing. Individuals then have to downsize when as the jobless rate continues to rise. But the good news is that's the service that we provide is helping those folks if they have to move somewhere else or move in with somebody else, or if they have to store excess inventory because their business isn't going well. It comes into storage and they can do it without coming into contact with the person. We've been we've been touchless before it was cool to be touchless, Joe. And in our industry, we've had kiosks in place for years and unmanned facilities. And so, for all those reasons, it does so well during a recession and a pandemic. We get paid because we get to lock people out and sell their stuff if they don't pay us. And the turns, the make readies are very inexpensive. So for all those reasons, we love the business and we love the time that we're heading into right now. We don't celebrate recessions, we don't celebrate pandemics, but the self-storage industry is always poised to do better during those times.
Now, if somebody was going to get into self-storage, they're a little seasoned. They bought a home here and there, maybe a multifamily. They're looking to automate. I love how you said kiosks. Aside from that, if they were to get maybe one person, a helper, or who would that person be?
It's always interesting to me to see the people that we consult with and educate, the people that they get. So, they like the person who cuts their hair. And so they think that person would be a great person to put in charge of their $1 million asset that's part of their retirement. Why I'll never know. But our industry, it also pays well at the higher levels, but starting out, to your point, Joe, if you have a smaller facility with fewer units and less traffic, you could over payroll your facility really quickly if you didn't have somebody in there that is, in that $15, $20, an hour range. And that's who you should be looking at. Somebody with real estate experience, that's a plus, but really at that level and at the facility, it's really more like a store. It's like a retail store, and it's a retail sales transaction. When somebody calls, if the person behind the counter answers the phone, they're selling them on coming into the facility to take a look around. And then they get there, they're selling them, if you will, or at least showing them the facility and then asking them to make a purchasing decision. And then whether they like to have renter's insurance with that as well. And any other ancillary, income streams that we offer at the site. So they have to have a sales mentality. We don't want them to be just a caretaker or somebody just sitting there. Clock watchers need not apply in my organization. That there always needs to be a desire to do better, and we have a performance-based compensation package in place for these folks. That if they do knock it out of the park and get the occupancy at the facility up to certain levels, they get bonuses and spiffs, and we treat our people well. And they want to do well for us and the brand, but we also compensate them based upon their performance as well. So I think those are some of the key traits you need to have in a person that's going to sit behind the counter at your facility.
That's awesome. I love that answer. Now, everybody has a formula when they're investing. In self-storage, particularly your asset class, your type of investment, some people look at IRR, some people look at cash on cash or cap rate, or what's your sweet spot of formula?
Yeah, I think if you're looking at a 2x multiple in the shortest amount of time, then I think the rest of it takes care of itself. That's pretty easy statement in a broad brush stroke. But if you're buying a facility and you're turning it around and you buy it for 800,000 and you're selling it in 2-3 years for 1.6, you're doing well. Obviously, there's a lot that goes into that. How much money did you have to spend to get it up to that level in terms of repairs, maintenance, or adding buildings onto it? But all things being equal, if you're doing that or buying a piece of land, a piece of dirt, and then you're building a facility and putting an income stream on it, if you can allow for a 2x return to your passive investors, your equity partners that come into it, you're doing well. But that all that is a math equation where you start at here's where I want to be, and then you go backwards from there. And is it realistic to achieve that with feasibility studies and consultants, looking at this all along the way, and underwriters. But those are the kind of the constructs that we work from. Existing facilities, we need to double our money in a short amount of time frame. In our development projects, the math is a little bit different, but for our equity partners, they need to at least double their money. Otherwise, we wouldn't be able to raise the capital. And there's probably not enough money left over for us to be able to do that just to pay our investors a 2x return. So that's probably the short answer that we could dive into maybe another time.
Of course. I'd love to have you back. So there's a lot of facilities out there. And I'm going to give you a small scenario. Tell me what are the pluses and maybe the minuses. Self-storage, 40% occupancy. What are some of the pluses, maybe the minuses?
Yeah. So we can talk maybe later about why you picked 40%, but at 40%,
random. There's maybe a deal on that.
Yeah, well, and that changes. I mean, there's always, there's always different scenarios for that. So at 40% occupancy means there's a lot of upside. how is the seller or the broker positioning this at 40% occupancy? Am I paying for the future value? In other words, are they still wanting a price as if it were 80% occupied and
Let's say
listing it based on pro
existing.
forma?
It's actually existing 40% occupancy. What's the upside?
40% occupancy. Yep. If it's at 40% occupancy, I want to buy it for the net operating income that's in place today at 40% occupancy. And then I get the upside, which means if I'm buying it at a fair cap rate, let's say it's a Class C facility and I'm going to buy it at a 7% cap rate based on the in place net operating income at 40% occupancy. What that essentially means, well, first of all, that's the bank needs to see that as well, because they have a 1.25 debt service coverage ratio that needs to be made. And if you're paying more for the property and it's only 40% occupied, it won't be able to cover the loan and you won't be able to sell it anyways. So at 40% occupancy, if I'm buying it on the in-place income based upon where it is now, my upside is gravy. So it's kind of like getting, one way of looking is I get 60% of the physical facility for free. And all I need to do is put the income in place and turn this thing around by, most likely if they're at 40%, they're not doing the things they need to be doing, marketing, a strong website, a kiosk to gather people, catch people 24/7, all the things you need to be doing and raising rates to the other levels. So again, a lot that goes into that, but that's where I want to be. Now, if it's a little bit higher, let's say it's priced above a 7% cap rate and the equivalent of if it were 60% occupied, because you got to give them some money for the upside. They want to, feel as if you're still compensating them, even if it's lower. Well, the downside to that then, Joe, is that the bank won't finance it. Then all of a sudden you're paying too much for it for the income that's in place and it won't cover the debt. And they just say no. So you either have to come to the table with a lot more cash or bring in equity partners or do something to bridge that gap. Knowing that if you're buying it at a value that's at 60% occupancy, you can still take it up to 90 and there's still gravy to be had. So I know we could do a lot of what if scenarios, but does that answer your question?
For sure. Thank you so much. Now, I read a lot of books, listen to a lot of audibles. One of these other gurus mentioned like, hey, asset classes are very, very different depending on where they are in the market cycle. And makes them more appealing or less appealing to others during the market cycle. Agree or disagree?
100%. And I can speak to a few of them because I've been in a few of them. Apartments. There's always going to be a need for people that have to rent, and so during a downturn, there are people that sometimes lose their jobs, lose their houses, and then they have to go back to renting an apartment or downsizing in some way, shape, or form. So they're not as affected as much from an occupancy standpoint, but from a valuation standpoint. They are, and multifamily tends to not do very well during a recession from a valuation standpoint because of inflation. Self-storage, a little bit different in that we actually thrive during a recession because when the development dollars go away and people and businesses are downsizing, they flock to storage. Occupancy, rises as well. And because we also do very well during inflationary periods when times are good because people buy more stuff and they have a need to store more stuff, we kind of have both ends covered. And so, if you just look back historically, and again, not trying to beat up any other asset class, but self-storage historically has outpaced multifamily, retail, hospitality, medical offices, everything except for, I think, data centers. Self-storage has outperformed through the last 3 recessions by double digits, greater than any other asset class in real estate. So, all that goes into the reason why I was interested in it as well. And because we, during an up and down cycle, self-storage does, much better than the other asset classes, mostly because we got it covered. People still need to store their stuff. They're either hoarders or they just have to they have to downsize and keep the little things that they can keep, but it's got to go in storage because they're now in another living condition, which doesn't have as much storage.
Good point. Thank you, Scott. Now, another guru out there said something like this. Hey, in multifamily, maybe it applies to storage. Not sure. I want to verify here. Hey, stay away from marketplaces or tertiary markets when there's just one trick pony, meaning like one business, military or Amazon. Thoughts?
Yeah, I agree 100%. And also along with that, I would say that, and I don't worry so much about the risk of only having one industry, although that is a risk. But what we've seen is, many times self-storage also does well during a downturn, as we've seen. When people are in trauma and transition, that's when they need storage. We're in the trauma and transition business. And so even in markets in which they're declining in population, well, that means people are downsizing and moving, and that creates a need for storage. But more importantly, if it's a one-trick pony town, meaning just one large major employer, that means it's so far out anyways, typically, even on the outskirts of a tertiary market where there's just not a lot of activity, and we need activity. We need people moving and moving in or moving out. But if it's a rural area and the population is pretty status quo and there's just not much happening, then there usually doesn't generate a need for storage. And if we're in the value add, play, if we're looking at those areas as a value add play, there's probably not much that we can create in value if it's not growing or if there's nothing happening. It's probably just, we can buy it and maybe fill it up a little bit more or slowly, and maybe, increase rates by 3% per year and just be happy with a turnkey property. But we don't invest in those markets because we need to have a stronger upside. So the answer is I agree 100%.
That's awesome. That's awesome. Now you're in a few different markets. What are some of your favorites right now and why?
It continues to be the Southeast. We're in Florida and continuing to, and, we're following a lot of the, international investment dollars. There's growth in, of course, along the shorelines. There always has been. We stayed out of California and will most likely always stay out of California. It's just very, very difficult to do business. It's very difficult to live in California right now, for one thing, let alone do business in California. But outside of that, we follow the coast, we follow the warm states. We like Arizona. We do like Colorado. We got projects going out there. We have a project we're looking at in Idaho, New Mexico, and and again, doubling down in Florida, have multiple projects in Texas as well. So, the states that have always been popular anyways, but now even more so during COVID. And as we look to more of an international investment economy, if you want to call it that, there's a whole lot of folks that are looking in those states here in the US that are buying up real estate in the more popular Sunbelt states.
Several years ago, I had a property in Colorado, and it was a rental property, and the pipes froze. So I was like, oh God, this is something new to me. How do people mitigate that risk if they're getting into self-storage, maybe some of these climate controlled storage units? How do you mitigate the risk there?
Yeah. So that was probably one of the biggest mind shifts for me, Joe, is I was hands-on. All of our houses, apartments, everything was, 15, 20-minute drive from me here. So we could always go look at them, as well as, if there was an emergency, like a frozen pipe. I live in Indiana, pipes freeze. We had our fair share of issues. When we got into storage and we started looking around the country, we realized there's no moving parts, there's no tenants, there's no HVAC except for our climate control now. And if it goes down, it's not critical. We keep it at 55 degrees in the winter and 85 in the summer. So all we need to do is keep it from freezing and boiling. But even if something freezes inside, there's no water pipes. There's no things that can get damaged, people's items that can get damaged. And, it's essentially a big open box with high grade, almost like a rabbit guard or chicken wire that goes over the top. And so the air flows through all these. If one unit goes down, it's not a big deal. And so there's not a sense of urgency in order for me to worry about, or it's just people's stuff. And if something should happen, it's nothing that a tenant insurance claim won't take care of. And on our end, we turn it into our insurance company, but it's not like people's lives are at stake, or there's some items that are, in peril that we need to go out there and take care of right away. If there's an emergency, which there hasn't been one yet in 15 years that I've been in the business, I can hop on a plane and go take care of whatever that is, but it's not critical because nobody lives there.
That's awesome. That's awesome. Thank you so much for that insight. Now, some people, I'm glad you mentioned the insurance part. Some people believe that hey, they should just get their own insurance. Some people want to take it in-house as the landlord owner. What are your thoughts on either or?
Yeah, we're moving now to a place where it's a requirement at almost all our facilities right now that they have tenant insurance. They either buy it from us or they have to show that they actually have a rider on their policy. And we have to see physical proof that, their contents are covered up to a certain level if they're storing them at a self-storage facility. Because what happens is when we offer them, and we don't sell it, we just offer renter's insurance. It's through a third party. It's just, if you have it, great. If not, then here's a company that you can go get it from, but you have to have it in order to rent here. And if they decline it, in the past, or for those owners that don't require it, we made them check boxes all over the place saying that they're declining it. And so that if there is a roof leak, and they open up the door and, there's a drip and it came down onto, an antique wood table, and they come in with a full head of steam into the office. Well, so sorry. Thank you for notifying us of the leak. We'll take care of the leak immediately. Well, what about my table? I said, well, turn it in on your renter's insurance policy, is what our managers would say. And if they didn't have it, if they continue to raise a fuss, we show them their, the lease agreement where they declined it. And so that's not a responsibility any longer, even if there was a roof leak. That's why you have insurance. So we offer it. We're almost requiring it. There is an amount of money that comes back to us from some of the folks, the providers that we do welcome in, and that are able to sell in our facilities, sell insurance. But it's very minimal. That is not a money maker for us by any stretch. More than anything, we just don't want to have to deal with clients who are taking up our time because they chose not to have insurance. And so that's why we're mandating it, putting it in place so that their items are protected, and that we just don't have to get sideways about in a dispute about whose responsibility is if there was an issue with a water leak, or a varmint that got in and chewed a hole through their couch, whatever that looks like. We just don't have to have that argument anymore if insurance is in place.
That's awesome. Thanks, Scott.
Mm-hmm.
Now, there's people out there that are taking courses. They're listening to this podcast. I want to ask you to put your instructor mentor hat on. Mm-hmm. Sometimes they get stuck. Like if there was somebody listening to this podcast, watching on YouTube, mm-hmm. Why are they getting stuck? How do you get them unstuck typically?
Yeah. Well, we've been teaching people for, I've been in storage for 16 years. We've been teaching people for 15 years. And it's usually two things. One, they just don't know what they don't know. And so then they second guess themselves. And then, ultimately fear is what keeps them, from moving forward then, or just realizing that, I can make a mistake. I don't know where to go, or I don't want to ask anybody, and time's ticking on my contract, or, whatever that looks like. And so they just stop, and that's what gets them stuck. They just don't know what they don't know. The second piece I would say, in terms of like growing and scaling, is when they begin to, look at the underwriting and, accounting for all, the money that goes into a facility, especially if it's a turnaround. They get stuck because they don't have the capital to be able to go forward, or they get stuck either on the first one, or when it comes time to buy their second one, because all their equity is tied up in the first one. And so, they get stuck because they either don't know how to find a partner or equity partners to move the business forward and to truly grow and scale until they figure that piece out, and then grow a list of people or partner with somebody else. So I'd say those are two of the primary pieces. And then, of course, the one overarching is always just a fear of failure. People are always scared about what other people are going to, say if they happen to fall on their face, or if they don't meet their goals or get into that first facility by the end of the year, like they told everyone. So that's probably the most, the number one and overarching.
Got it. You have an amazing event coming up. Tell us a little bit about what people should expect and maybe why they should go.
Yeah. We've been teaching people how to do this for 15 years, and my team, I'm not patting myself on the back, but our team is the best in the industry. We got more success stories, and we've helped more people get into the business than anybody else. And that's because we walk the talk. We're all investors, and we're in the business day in, day out. We keep our ear to the ground to see what's going on in the economy and with financing and interest rates, because that is the business. And we know what are the hot markets, which ones are declining. And we have access to a whole lot of folks that are out there finding properties that are sharing them within our community. So we built this ecosystem outside of just coming to a 3-day event and learning about the business. We built an ecosystem, and we're doing this again at a scale that is greater than anybody else in the country right now. We're wholesaling and sharing deals with each other and off-market projects that nobody else sees in the market, because we built an army of people that is out there doing this business the right way, the way that we've learned how to do it from the beginning. So in 3 days, we can't teach you everything, but as you can see or hear, I'm a pretty fast talker. So is the rest of my team. We get a lot of information across, but we cover from, A to Z at not a 30,000 level, and really not a ground level, but maybe 5,000 feet, how to find, purchase, manage, and grow and scale a self-storage business, and everything that goes in between there. And we do that over the course of 3 days. It's not a pitch fest like most other events that many people have been to. It's just our team talking about self-storage and walking through the steps A to Z about how to do that over the course of 3 days. And so proofs in the pudding. That's why we're at the place that we are right now, and we have the opportunity to be able to partner with many of our students that we teach about the business as well. So that's, I guess, the best shameless plug I can give for our organization is really just the proofs in the pudding. We're doing it. We're walking the talk, and the experience and the success is there from our students.
That's awesome, Scott. You're also a philanthropist. Tell us a little bit about your spirit of giving.
Well, I don't know, it just comes out of obedience. I recognize where my gifts and talents come from. It certainly isn't from me. And, we're asked to be obedient and to give back and to take care of those less fortunate than us. So we've been doing that since the beginning, is taking 10% of the profits of our businesses and putting them into a fund to go build houses down in Mexico. And we've also gone to the Dominican Republic through our partners with YWAM, Youth with a Mission. And so we go twice a year, and we'll build 2 to 3 houses per year. And we will take our staff, our friends, our family, coworkers, partners, and really anybody else that wants to go along. And I'll call it an almost all expense paid short-term mission trip. It's our goal to introduce people to the mission field in a family-friendly mission trip where we build a house in 2 days. It's a 4-day trip, a day of travel on the front and the back end, and we take care of all of it. All people have to do is pay to get out to San Diego. And then we take the bus across the border down into Ensenada, Mexico, very, very safe cruise ship town. And then we drive 20 minutes from there and go help some folks that are in some of the poorest parts of the world. And we build a house and we give it to them.
Yeah, that is awesome.
That is our mission. And we've been doing this. We built houses 18, 19, and 20 over Thanksgiving, and we're getting ready to go back again in June.
That is awesome. Scott, it's such a pleasure to have you. Shared amazing words of wisdom. Best way to get a hold of you. Anything else you wanted to share before we wrap it up?
Best way is selfstorageinvesting.com. All things self-storage. If you're looking to invest actively, passively, learn about it, learn about our mission trips or anything else. Head on over to selfstorageinvesting.com, and my contact information is there as well. Any other parting words of wisdom is, folks, pay attention to the marketplace and what's going on with interest rates and the true cost of money and your investment dollars to make sure that you're not going backwards. You need to be an asset class similar to self-storage or something that's earning greater than the rate of inflation, or you're going to be going backwards. And so keep an eye on your money so it continues to work for you in that passive fashion, like you mentioned, Joe. Just putting it out there and hoping for the best is not a strategy. So you need to pay attention to your money, get it working for you. Otherwise, you're going to be susceptible to, what the market is going to give you. And it's not looking all that great right now. So that's it. Take control.
All right. Thank you so much, Scott, for having you, being on our show. We really, really appreciate your time and words of wisdom.
All right. Thanks, Joe. Appreciate you.